Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Happy Friday. We are back with another episode of the Tech Behind FinTech. Really excited for this show. A good friend of mine, former colleague, great friend, Matt Beecher here. Matt, welcome to the show.
Thank you, Mandy. Good to see you, and thanks for having me. I appreciate it.
Well, like Matt just introduced me, actually. I didn't introduce myself. The host of the Tech Behind FinTech. Today, we are covering a step-by-step guide to getting your FinTech funded. That has an extensive experience with various startups and funding and angel investing, serial entrepreneurship. I'm going to read his extensive bio. Before I get into that, I want to just do some housekeeping things. Obviously, as we talked about, the show is the Tech Behind FinTech. We are streaming live from Facebook, LinkedIn, YouTube, Twitch. We also have a stream going from Instagram. That you just see me. If you want to see the full episode of Matt and myself, please go to techbehindfintech.com and a link to YouTube should be there. Today's episode, once again, a step-by-step guide to getting your FinTech funded. Now, with those housekeeping things out of the way, let me introduce Matt's bio, and then we will get into some fun stuff. Matt is a successful startup founder, business builder, innovator, operator, executive, and investor with a 25-year track record of success. He's a proven leader with deep experience in developing and enhancing growth across all facets of strategy, technology, sales, marketing, finance, operations, and fundraising from inception to exit. Beecher co-founded Red Star Ventures, a first-of-its-kind venture studio that creates companies, taking them from the earliest stages of ideation and growing them through their first institutional funding rounds and beyond. During his tenure as president, he led the formation of 6 companies and 2 exits. He also co-founded SCS Financial, an investment and wealth management firm serving family offices, and institutional investors. The company grew from 0 AUM to an excess of $30 billion before being acquired by Focus Financial for greater than $600 million. Matt, a native Bostonian and avid Red Sox fan, resides in Austin, Texas. Love it.
That sounded pretty good. That's a lot of fluff there, but thanks for reading through that.
I'm happy I have people like you in my network. That's not good sounding. For real. So, welcome to the show. How are you feeling today?
Yeah, it's good. You know, it's 70 degrees here in Austin, Texas, and in December, you can't beat it, right? It makes you feel pretty good.
Especially being from Boston, you definitely
Yeah,
can.
exactly. Yeah, exactly.
So, you know what? Before, obviously, the show's about venture, getting things funded, a step-by-step guide. But, you know, before we get into that, I want to get into like you and your background. And what brought you into the financial services industry?
Yeah, look, we got to go way back, you know, to the beginning. And you know, I got my start a long time ago as a stock analyst for an investment management company in Boston. I think I was all of 22 years old, analyzing stocks, investment opportunities. And these are back in the days, Namdi, I'm going to date myself now, where stock quotes were fractions. They were not decimals. They were still represented as fractions. So that's how far we're going back. But that was sort of my first entry, you know, into the financial services world. And I just loved it. You know, I loved everything about it, from advising, you know, clients to sort of the nuances of picking stocks, you know, to how the infrastructure works. And, you know, back in those days, it was a broker-led operation, right? Where you had to have a broker, you know, that bought and sold stocks for you at 3% commission. You know, those days are long gone. But that was kind of my entry point, and I had some pretty good stops along the way with public accounting firms building out financial services and investment management services. And you know, the story goes, I was working for a public accounting firm in Seattle, running a investment management, wealth management practice within the company. And this was Seattle during the days of Microsoft and Amazon and, you know, big booming companies that changed the landscape of that city. And I'm looking at this saying, God, all my clients are getting really rich, like really, really rich. Like there's something happening. This is like 1997. There's something happening here. Like, how do I get involved in this? And, sometimes it's better to be lucky than good. And, my phone rang one day and it was a recruiter for a company down in Silicon Valley said, hey, would you, be interested in coming joining? We're building a whole technology platform for, folks to manage this explosion in wealth. And I'm like, okay, first I got to figure out where Silicon Valley is. I have no clue. Like I've heard of it, so I got on a plane, flew down to San Jose, and that was my first entrance into really kind of building product and understanding kind of the investment cycles that you have to go through and growing a business. And, that business was called My CFO. And, we went from 30 people when I joined to 300 in the span of like 3 months. And we raised $150 million, back in 1999, which is kind of unheard of today. But that was kind of the first entry point into that. And we ended up selling the company to Bank of Montreal through kind of the boom and bust of the Web 1.0 bubble, or the .com bubble as they called it. And I was just hooked. I was hooked. I'm like, this is how I want to spend my time. So again, I got lucky through my career where I was able to work with some really, really great teams, some incredibly intelligent people, and had the good fortune of having some wins and a lot of losses. Like that comes with the territory as well. Everything isn't up and to the right. It's not linear. There's nothing in this world that is. And especially in startup land where, you have to deal with the, vagaries of abstractness that exists in a startup, and being able to kind of weather the storm. But I was all of 30 years old or 29 years old at that time, and I was like, okay, this is for me. This is where I want to be.
That's awesome. I want to touch on certain things you said during the story. Number one, what was your initial background? Like, what did you major in order to get that entry into the financial services?
I was a finance major, and I went to Northeastern University in Boston. And kind of the cool thing about Northeastern, and I think you see a lot of this now, it was a co-op school, right? So it was actually a 5-year undergraduate program, and it was kind of work study. So you actually got placed. You had a job, for part of the year with large companies. I worked for Liberty Mutual and some other, big companies. And that allowed me to get exposure to companies before I even graduated college. So I had a job coming out of college, being a stock analyst. So I have a huge affinity for Northeastern. They really allowed me to kind of create my first step in building my career.
So now, right, you're into your career, things are stable. You get this call, you're in Seattle, you get this call from a recruiter who says, you know what, we want to build a technology platform to support, my CFO and support from the accounting aspect. That's a major move, right?
Yeah.
To basically drop everything and make that move.
It wasn't, Namdi, because what was happening at that period, and this is kind of the .com boom or the Web 1.0 boom, where a lot of the technology sat around digitizing paper. Basically, it's like you've heard me say this in the past, and I'll say it now, like technology needs to do something, right? And it's really critical. It's a critical question to answer whenever you have sort of a startup. Like, what does your technology do? And that's really, really fundamental to kind of creating any company. But at that time, just the pure, digitizing PDFs was state-of-the-art technology in 1999, right? I mean, that was kind of the notion of it. So it really wasn't a massive departure for me, but it was sort of the first time I had exposure to software engineers and product people and actually understanding what happens underneath the scenes. It's not just pushing a button, but we see it today too. I mean, back in 99, it was digitizing and trying to make easier manual processes. And if you think about AI today, and especially generative AI, it's all about how do we take manual processes and, allow the computer to do it for us. So not a huge departure, for me. I mean, I think there's a lot of parallels between those two periods. The reality is technology's become, easier to access, and a lot more smarter people are kind of working on big problems.
So now help me out. All right. So your first venture into startup, you were working there. It worked out. Company got sold. What happened next?
Yeah, so it was really interesting because the company at the time was, one of these major disruptors. We were a big player in what I'm going to call the wealth management space, or kind of the digitization of wealth management. So it's almost like you have this big halo on your head. It's like, oh gosh, Matt worked at my CFO. Like, that was a very innovative company, and we want to be innovative too. So I had the good fortune, there I was living in Silicon Valley, and I decided to pack my bags and move back home to Boston. And, I got approached by this group that was kind of creating the next generation wealth management platform using technology as sort of the fundamentals behind it. And, I was lucky enough to be a co-founder of that company and join people, quite frankly, that were a lot smarter than me. So I was just a young buck at the time, and I felt very honored and humbled, quite frankly, to be in that. And we built a business the way businesses are built. The old saying is, Nambi, right? It only takes 10 years to be an overnight success. And it took us 10 years to build that business. It took us a decade. And
Wow.
we went from zero. There were four of us sitting around an office. I think we had one conference table and like 800 chairs, because we subletted from a .com bust company that needed to sublet their real estate. And it was like the four of us sitting around the table going like, what the hell are we going to do here? And we grew it from zero to 30 billion of assets under management. One of the leading, if not the leading, wealth management platform in the country, and had a successful exit out of it as well. So the moral of that story is, it wasn't linear, it wasn't easy, and it takes a long time, right? And I think the media loves to kind of pop up or prop up, hey, look at this company, 2 years they sold, that they have a 2 billion or 3 billion or $5 billion valuation. Like, that's just the headline news. Like, every company doesn't work like that. In fact, it's the opposite. I read this morning that 3,200 startups have gone out of business this year alone. This year alone,
Wow.
3,200. Now, you could make the argument that maybe a quarter of those should have actually been funded, but the point is, it's really tough, and it's more failure than success along the way.
You know what? Like, in talking to founders and that actually hit major milestones, I love the way it just gets brushed over in conversation. Yeah, we went from 0 to 30 billion.
Mhm.
Yeah, but then keep going. I always love that aspect, but it's major, right? That's
Yeah.
a major thing. How did that work out in terms of, it's four of you guys sitting across a
Mhm.
table, small conference room, right? You grow it in 10 years. How did the funding process work out for that particular
Wow.
venture?
I tell you what, this is an anomaly for every company I've ever been involved in. I think we took in about $1 million of investment capital. And it was one of those things where we didn't take salary. It was all these things that you do in the startup grind. But I think we only took in $1 million, and it took us a year to get our first client. I mean, it was like there were moments, Namby, where you're like, "This ain't gonna work. I gotta go get a job. Like, this is a train wreck." And it wasn't. It was, in fact, the opposite of that. That we kind of had a lot of operational discipline at the beginning, and it took us a year to get our first client. But as soon as we did, we kind of moved to profitability pretty quickly. So we didn't have the need to bring in additional capital. And I think when we did bring in capital, it was really in a secondary offering. So some people could take money off the table because the business ended up being very, very successful. So that's not the norm by any stretch, but it was good operational discipline, to have a business that wasn't highly diluted with investment capital.
So a couple of things with that, right? Number
Mm,
one, and I want to, and the reason we're going into these early stages before we jump into the step by step
mhm,
guide, because I think it's helping people to further understand. You said something, operational discipline, something you repeated multiple times, and I'm going to
mhm,
get into exactly what do you mean by that. Like, I have
mhm.
my own assumptions, but two, you totally, like you said, hey, for that first year we took in 1 million, but we didn't take salary, right? That's accurate, correct?
Mhm, mhm, yeah,
For a lot of founders, obviously you have families, you have that
yep.
may be difficult. So how did that process work? Like, what was that conversation like among your partners?
Yeah, look, it's and it's not just that company. It's kind of every company, which it's a bumpy road. It starts with a good concept, a good idea. You validate the market demand, there and you're like, okay, there's an opportunity to solve a business. And with that company, it's that we felt like we were obligated to start this company because we knew how broken everything was. So it was a classic sort of disruptor. But it was bumpy. There were moments where it was like, okay, we're just going to pull, the tent pole here and pack it up and say that was a fun experience. But you got to keep going, right? I mean, you got four partners, they all have families. Everybody's sort of betting on this. You got to bring your A game every day, because it's like, geez, so this could be the last day, right? And you just want to make sure that you do that. So you got to take deep breaths and just dive into it. It's like, the Greek divers, right, that go cave diving. It's like at some point, with no oxygen, at some point you make a decision like, do I go back or I do go forward? I don't know when I'm going to see light, but I'm just going to keep going forward. And that's kind of the decision that you have to make. And those are hard decisions. At the time I was, expecting twins. And it was like, oh my God, what am I doing here? This is crazy. Like, I need a job. But you work through it. And, it's teamwork. I mean, that's probably the biggest component here. And just being all galvanized around a particular idea and the belief that you can kind of do something different because it's worth it. So it's a lot of psychology, to be honest with you. You got to convince yourself that you're doing something really good. And you get validation along the way. Right. In this instance, we got clients. In other technology companies, we have users that are engaging. In other companies, we're selling, into enterprise, for example, and you actually close a deal, right? I mean, those are the things that are like, okay, we got something here. The converse of that is like, at some point, you just got to look at this and say, it ain't going to work. And you got to have, the guts, I guess, to be like, yeah, we're pulling the plug. And here are the 20 reasons why.
So let's touch base on that, right?
Sure.
You get 1 million, but it took you a year to get your first client, right? In that year, right? What were the validation points? Because you didn't have a client yet. So what's the validation? Is it? I mean, obviously, it's altruistic things. Look, we're doing something that we know the industry needs. We understand that it's greater than us, so that's what's keeping us there every day.
Yeah.
But what are the validation points to say, you know what, this thing is working versus this thing is not working before that year is up?
Yeah, I think what was really interesting with that business is even though it took us a while to have client validation, paying client validation, we got a lot of validation early on from the ecosystem, meaning these are really smart guys. They're doing something that needs to be done because we know the old model was broken. They're taking a fresh approach. At the time, we didn't have the hangover of, technology debt because just didn't exist, right? And there wasn't that notion that we could build something from scratch. The other thing that we had that was good validation, sometimes it's timing is everything. We came off of the dot-com crash basically, so every investment manager in the world had awful returns. We started the company after that, which in hindsight was the biggest key to our success. It was just a timing exercise because we didn't have a bad track record. We didn't have a track record, which actually worked in our favor because people were like, oh, I'm not staying at Goldman Sachs, for example, because the returns were awful, through this period. It's like, well, we didn't have that problem. Lucky us, and people were like, okay, I can start fresh. And the good thing is we had, ecosystem validation, around the horn. And we knew it was just a matter of time. We just knew it was a matter of time. And that's exactly what it was and happened.
So, all right, cool. Let's break that down, right? We have a year. The validation steps from an industry perspective. Number one, these guys have great backgrounds, smart guys. So it's like, okay, so I look at that as team, right? We trust our team, number one. Number two, right? They're trying to solve a problem here that is definitely needed. That's what the ecosystem is telling you. That's what the industry is telling you. So before that first client walks through the door, these are the things that keeps you going. These are the things that keeps you going through no salary. These are the things that keeps you going through, potential. Because obviously in the process of getting that one client for a year, there are 1,000 clients who said, no, we're good. No, we're good. So throughout all the no's, those are the big things that keep you going.
Yeah.
When was it? Did you guys think about the pull the plug? Like, you know what? If we don't get a client in 2 years, if we don't get a client in 18 months, like we're going to play. Was there ever that conversation?
Well, it's interesting. I think some of that was tested early on, right? And it was like, okay, what does pulling the plug really look like? What does that mean? How can we sort of get out of that? And you really sort of thought, creatively about, how you potentially do that. But I think all of us had pretty high conviction that the existing models were broken and somebody needed to fix it. And why couldn't it be us? And so I think that was it. And the other thing is kind of interesting here, even though we had external validation and that felt really good, and it took us a while to get our first client, operational discipline, I'm going to tell you exactly what we did. In that year period, we probably said no to 4 or 5 potential clients because they didn't fit the parameter of what our ICP was, our ideal, client portfolio. They fell below that. And we made a really big decision. It wasn't my decision, it was the CEO's decision, which was brilliant and gutsy to say, you know what? We started this company to do X, Y. No way, no how. And we stuck to it and we said no. And it ended up being, at the time, a breathtaking decision. It's like, I gotta pay my bills. Like, we got to take somebody to prime the pump. And the reality of it is, if we had done that, the business would have failed. It just would have failed. And, so go ahead.
Why?
Because we had sort of built on a fundamental thesis, and anything that fell below that thesis, we knew our unit economics were going to be terrible. And we had seen it happen in the market before, where competitors of ours were taking clients that didn't fit a profile, that were lower than a profile. And what happens is gross margins, go to zero on that. And maybe you even have negative margins because the cost to support, a client that's X minus Y costs you the exact same amount as your ICP. So if we had done that, we would have built a terrible business, a low margin business. And, it takes discipline to be like, no, here's what we're doing because we can generate this from a unit economic perspective. We think the market is big enough and we're either going to make it on that thesis or we're not. And let me tell you, like, I look back on it and I think it was one of the most gutsy, calls I've ever seen a CEO make. And it wasn't me. It was, another gentleman who's incredibly talented. And I was like, okay, all right, that's pretty cool. And it takes about 3 years to realize what a critical decision that was. But it was like, wow, that was everything. That made the business.
That is an extremely difficult decision to, one, make, and 2, get your team to buy into. I feel like that right there, because let's understand it's always interesting in hindsight to say, oh yeah, that was a great decision. We did it. In the moment, bills are not being paid. These guys are not getting salary.
No.
You have your sales guys going after clients that are saying no, 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 no. You finally get people that are saying yes, 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 yes. And you're saying, you know what? No to them. Oh my goodness, it's hard. I mean, I always say this is always something that I use. I say, would you rather hunt with your stomach growling, like being hungry, or would you rather hunt being well fed? And one of the things I always think about is like, you want to hunt when you're well fed because then you don't make bad, desperate decisions. In this situation, you're the companies in like, yeah, you got funded, but people not getting salary. So it's so easy to make desperate decisions at that point, but you didn't.
Yeah, it's pretty amazing because so I'll give you another example of that business. And again, in hindsight, probably one of the best CEOs I've ever been around because the decision making was bold but purpose driven. So, your example, we were hunting hungry. We were starved, man. But we said, you know what? Like, I'm not eating that. I am waiting to eat this because I know it's going to be better for me, right? It's going to be a better food source for me. But the other thing happened here, as soon as we got those first few clients, our business took off because the world was waiting for external validation. As soon as we had that, this business took off. Like, and to the extent that I've really never seen before, hyper growth. We got to a point about 3 years into the company where we kind of looked at it and said, if we grow at the current clip, this whole thing is going to collapse. Our infrastructure wasn't built to support this level of growth and how quick it was, right? 1, 2, 5, 10 clients. It's like, great, we can support that. And maybe there's a lot of manual stuff. So we got to a point where, again, the decision was made to say, timeout. We're taking a timeout and we're not going to take on new customers for 6 months. And we're going to take that 6 months to really build our infrastructure and processes the right way so we can continue to grow. Because the alternative was we're just going to keep throwing bodies at the problem. And the next thing you know, you got a company with 150 people and 125 of them are doing admin work. And we knew that wasn't a good model either. So you talk about bold decisions. Like, again, this guy goes, on Mount Rushmore for good decisions. It's like, we're not taking clients that are below our ICP. And by the way, we're going to stop this business for 6 months while we build for future success. Whew, that takes guts, my man.
No, I'm looking at it from a technology perspective. Obviously, there's other business processes in place, but he just took the time to eliminate technical debt.
Yeah.
Among other things to get the processes right. I will say, gutsy, right? My opinion, a lot easier to make after rejecting the 5 clients when you're starving. Because now life's not great, but it's not bad at all compared to where so
no.
It's almost like he set this precedent to say, you know what, like, it's not about bringing the wrong type of clients in, number one. And number two, it's about the clients that we do bring in, we have to be able to fully support them. So I'm willing, and it's just kudos all around in terms of decision.
Yeah, look, and there's this old adage, right, in startup land, that startups tend to drown, not starve. And we see it all the time because there's a lack of operational discipline, and or you have VCs, part of the topic of this conversation, or investors that are like, no, you got to grow at all costs. I don't care where growth comes from. You just got to drive top line growth. And a lot of times that hurts your business, right? Because what happens is you're taking on customers, if you're a technology company, that are just gumming up the works, right? It's not your perfect customer, and all of a sudden you got to spend a lot more on customer success, or you have to do things that are kind of unnatural. And it's always sort of tucked into sort of this notion or this explanation that, well, we just need customers to prime the pump, right? And we're going to take these first 10 customers at a massive discount, and we got to do it because we got to prime the pump. There's some truth to that. But, I think there's a lot of detriment to that. You just have to be careful. You got to be really, really careful about how you sort of approach that, because, you kind of do that and you discount business too much. You're going to find that you have a really crappy business, to be honest with you. And once you're there, it's really hard to back up the train. Once it's down the tracks, forget about it. It's really, really tough. So you see a lot of startups fail, not because they don't have sufficient funding, but they have growth that is bad growth. It's like, I know you're a fitness guy, but it's like, it's that notion of like a calorie is a calorie is a calorie. And it's like, no, it's not.
My biggest pet peeve, like, to set the stage, right? I do a lot of combat sports in terms of jiu-jitsu and grappling. So I'm in the weight room, though. I like strength training. Biggest pet peeve are guys in the weight room who come, and these guys are trainers too, but they're like eating total crap I'm not a bulk guy. I just train. They're like, no, I'm eating like cake, and I just need to get the calories before.
Yeah.
And I'm just like, you're totally missing the point of fitness and nutrition. Whole other topic. We do have a question from Instagram. My guy, Jim Coon. At what point did they start taking a salary?
Oh, I think once we got our first customer, or our first client, that was sort of the, we had money in the bank, which is good. But as soon as we got our first couple of clients, whew, we sort of breathed a huge sigh of relief, and then we kind of right sized the economics. So it wasn't this massive period of time where we did it for a period of time, which was important, to the business to do it during that stage. And I think there was some fortunate aspect too, where people could do that. Everybody can't, right? And it's sort of the ramen startup founder. It wasn't that extreme, but you got to tighten the belt, and it got to a point where we felt comfortable that this business was going to grow. So we altered the economics a little bit, which was you have to do it. You can't do that forever.
I want to get into. I mean, because I think this conversation so far set the stage into the step by. Because you dropped a lot of important lessons that startup founders and fintech CEOs and people that are in their quote unquote the stereotypical garage or nowadays
Yeah.
right, trying to figure this stuff out. I think it's going to be lessons that even for me myself, you could look back in this first half of the conversation to now start going, wow, that those are good points that he made, and I'm going to take some of that. I will ask this before we jump into the step-by-step part. Do you feel that it was a lot easier to make those types of decisions, that you said no to customers, you stopped the hyper growth before scaling up, because you didn't have this massive set of VCs that you had to answer to? You took $1 million only. Like, so it's
1,000%. If I could go higher than that, I would. Like, you think about keys to success, and we didn't have the overhang of venture capital money coming in. Which, look, there's massive benefits to that, because you need fuel, to kind of to grow your endeavor. But it kind of works both ways too, and it cuts in a bad way when it doesn't work. So yeah, if we had quote unquote venture money into that business, it wouldn't have made it. There's no way. There's no way it would have. Not a chance.
wow. So
But you want to know why? Just to finish that thought and go back to the calorie example, sales is the same way. So think about, sales or revenue is that. Revenue isn't revenue, just like a calorie, isn't calorie. There are good calories, bad calories. There's good revenue and there's bad revenue. So you have to almost make those decisions as your own nutritionist, but in the scope of a startup, right? You want to fill the body with good stuff, not bad stuff.
That's a excellent analogy, and I like 100% relate to that. My experiences, startup world, and so forth. So let's get into it now.
Yeah.
Let's set the stage for people who are not as familiar with venture capital and the different funding steps. Everyone hears, in the news, oh, these guys just got their Series B. Oh, we need seed, or they're working on their Series D. Can we start just going through the definitions of some of those things?
Sure. Yeah.
So we could start from the first. Let's go to seed stage, right?
Yeah, this is typically first dollars in. There might be a dirt stage round before that, which is friends and family. I just made that up, but I think you get the point. So that seed stage tends to be the first institutional capital that can come into the round. This is where a lot of VCs play in being kind of first dollars into a company. So these are going to be lower amounts. Maybe it's 250, maybe it's 500, maybe it's $1 million if you're really, really good. But at that stage, you got to match the business to the stage, right? And typically seed stage might be pre-revenue or in the early parts of just testing out the revenue model a little bit. So it's trying to answer at that stage. You're always trying to answer critical questions. You aren't taking that money in to say that's all the money we're ever going to need, and our model shows us that we're going to have hyper growth here in month 6. Everybody's models show that, right? But if you really think it pragmatically, that stage of investment, you're just trying to answer a couple of questions. You have hypotheses around this you don't know, and you're just trying to answer, can I get answers to these 5 questions during that stage? And if I can get good ones, then we go to the next part.
So thank you for that. So like
Mhm,
we're at seed, but obviously
mhm,
we skipped over some things that you just
mhm,
mentioned.
mhm,
So there's pre-seed,
mhm,
so like friends and family,
mhm.
pre-seed, then seed, you would say?
Yeah, I mean, everyone's different. It's really interesting, Namdi, because the definitions of everything, it's not an absolute, right? The definitions of these things change all the time. I mean, 10 years ago, 15 years ago, the notion of seed capital really didn't exist, right? Because, or maybe 20 years ago, because the cost of computing was really tough. The barrier to entry was really high. So a lot of times you saw those first rounds of capital coming in being large amounts because you remember back in the day, you didn't have cloud computing. You had to buy computer space. You had to buy servers, right? So the entry point was so high. I mean, you and I could start a business after this webinar, and it would take us 10 minutes to set up an infrastructure in Google or AWS or whatever. Like we could be up and running in hours. Um, rewind the tape, man. That was like impossible. Impossible. So the point is these stage definitions have changed dramatically. And there's not kind of a one size fits all, but there is a progression, right? Round one, round two, round three, and then subsequent rounds there. Call it seed, series A, series B, call it whatever you want. But that's typically kind of the progression. And the outcomes that you're trying to drive are exactly the same. First round of capital, let's answer critical questions. Great, we did that. Next round of capital, let's see if we can get people to buy our product. Or maybe they've bought our product. Can we prove out that this is repeatable, right? And then the subsequent rounds of financing, call it Series B and above, this is the prototypical put gas on the fire, right? We have something, we have a repeatable revenue model. The product we found MVP or we found our product market fit. Now we can kind of dump more gas on the fire because we have a fire, right? A lot of times you might see Series B as sort of like, oh, I think this company can make it, it's in a bad shape, we're just calling it a Series B because they already did 3 rounds of financing, and it might be a reboot. There's a lot of things that go into that, but that's the typical progression that you'll see.
I worked with startups that even leverage this new thing, crowdfunding. Right?
Sure.
It's like I'm trying to raise money. They just put it on there. It's like different crowdfunding apps. But one didn't use an app, and literally friends and family crowdfunding it. It was able to raise like $500,000. And
Yeah.
that really took them to the stage where they could answer better questions. They put themselves
Mhm.
in a certain situation where they now can start looking for the next stage up, mil plus, and so forth. So and for those, I think that was crowdfunding was introduced in 2013 as part of the Jobs Act, if
Yeah,
I'm not
it was.
mistaken.
Yep, that's exactly right. Yeah, that's it. And that basically kind of removed the accredited investor rules that made, quote unquote venture investing, startup investing open to the masses with some rules and regulations. So I think that's why, look, at the end of the day, like I think we've become dogmatic about this notion that I have a startup, therefore I need to raise venture, right? That's sort of the mentality. And that's not always true. I sort of look at it in the companies I'm involved with and, past companies, it's like you got to think about the whole spectrum because maybe there is an avenue to success that doesn't include venture money. And if you can take that path, I would say, every day of the week, you take that path. You take it. If you don't
Mm.
need to take that capital, don't. And it might slow your growth a little bit, but I think it's going to allow you to grow at a sustainable clip, right? And kind of prove that out. So it doesn't have to be. And look, at the end of the day, it's optionality too. If you can do certain things, the more optionality you have. If you're an early stage startup and somebody's willing to write you a check, that's the only avenue you have, right? And you got to take it. But as your business grows, I think optionality is critical. And it doesn't always have to be quote unquote venture money that goes into the company. I've seen plenty of companies that have done well without taking a stitch of venture money.
Let's talk about the venture side.
Hmm.
You just mentioned if you don't have to and you can grow without it, no, what comes with it? What are the things that people don't see that comes with that? Once that
Yeah. There's really kind of two things. One is economics, and the second is governance, and those are kind of the two things. And a lot of investors want both. They can't have both, so they kind of settle on one or the other. So there's two big overhangs, right? If somebody's putting money into your company, you got to understand how venture economics works in the background, right? Nobody is waiting for your startup. It's really become a kind of a weird dynamic. But you have to sort of understand from a VC's perspective, they're running a portfolio of companies, 50, 60, 70, 100 companies in the fund. Um, they need like one or two to return the fund. And that's kind of the game. I mean, it's like the record industry way back when. They're just looking for hits. That's it. And sometimes you got to put a lot of money out there to find that one or two hits. But that's sort of undue pressure, on a company too, because everybody's looking for a moonshot versus just a very stable, really good business. Like, hey, we're profitable. Look at these great things. Like that, we lost sight of that. It's coming back into fashion, which is really, really important. It's like the notion of like, oh, I'm going to invest in sustainable businesses. But I think we went through a generation where it's like top line growth, top line growth, top line growth. And that can really sort of mess with the natural progression of a business. So you have that to contend with. The other thing, in a lot of cases, you have governance, requirements that fit there too. You're going to have somebody on your board. You're going to have people that are sitting around you telling you, you should. I hate that word. You should do this or you should do that. And it's like, really, dude? Like no. So you have these pressures that a lot of times can force unnatural acts in a startup because the outcome needs to be, a 100x return. That's what the outcome needs to be. Nobody cares about anything less than that because it's not going to return their fund. It literally has no economic value. Like if you returned, one time money, two times money, like why do I care? It doesn't do anything for me. Wow. So you got to understand both sides of the table.
Okay, cool. That's a lot to unpack there. We might need a follow-up episode to do that.
Oh.
Now, for companies that want to go in that direction, they're an early stage company, they want to start approaching VCs. How can they put their best foot forward?
I think just like in sales, well, first let me say this. It is a long road to hoe. It's really not the easiest thing in the world. And you got to have thick skin because you're going to get, a whole bunch of no's, like a truck full of no's. And, the old adage is like, well, it only takes one person that's going to write a check. But the amount of work to get here, like the math is so, backwards on all of that. But I think with anything, you got to understand what stage you're at. You have to be very, very clear about that. The biggest number doesn't exactly mean the best number, right? Is it better to take 1 million at a seed stage versus 10 million? I would say absolutely every day of the week. Like you still have stuff to prove out. But I think going to that ideal customer profile or the ideal investor profile, you got to do your homework. If you sort of do that, you're probably going to exclude a whole bunch of people that just aren't worth talking to because they don't invest in your stage. They're not in that industry. They don't have expertise. Their history suggests that this isn't a good, it's like, don't waste people's time. So I think the more work you can do up front, building out the taxonomies, because getting meetings isn't the most, difficult thing to do, but it doesn't mean, the more focused you can be, I think on that early stage, it's really important. So you got to do homework and then you got to make sure you have a good story. And I think the most important thing, and this is now really sort of being exposed, and I'll just say it as bluntly as I can: don't lie. Just don't lie. And lie might be too extreme. As a founder CEO, I've been there before. You want everything to be perfect. You want to tell somebody what they want to hear. You're willing to pull forward some stuff to say, hey, we're doing X in ARR, when you might actually be doing a little bit less than that. But I think the moral of the story is don't lie, because it's just going to erode confidence and it's not going to make for a good experience at all. So get your story straight, Be very, very targeted about who you want to approach, network the hell out of it to get in front of folks, and make sure you have a really good story. That story is going to be important. And you just have to admit where you are. We're seed stage. We have a product. We think we have product market fit. We have an awesome team. Here's the size of the market. We think it's large enough to kind of go after, and we're the right people to do it. Okay, put that together. It doesn't mean that you have everything figured out. You don't. You might never have it all figured out, but I think it's just being honest to the process and where you're at.
I like those series of questions you just posed, because whether you're looking for VCs or not, if you're building something of value that you want to put out there, just having those questions answered in a nice, succinct way, I think is just a good look overall.
Yeah, overall.
Right?
Mm-hmm.
So we have another question from the Instagram, and then after that, we have to jump into our message from our sponsor. Yeah, definitely need more explanation on the 100x ideology.
Yeah, it's just economics. It's fund economics, right? If you look at how VC funds work, it's typically what's called 2 and 20. This is sort of generalization here, but you take a 2% management fee out of the size of the fund that basically pays salaries and funds the operations of that fund. And then the 20% is what's called a carried interest, right? So typically the fund will get 20% of realized proceeds, after a certain hurdle is met, right? So it takes a long time to actually get there. Everybody thinks, being a VC means you're a billionaire, et cetera, et cetera. No, not even a little bit, man. It takes a long time to build up the economics. But if you look at a fund economics perspective, getting a 1x, 2x on returns really doesn't do much for you, because you're not going to, exceed hurdles, and you're not going to return the fund. So really everyone's looking for moonshots. It might not be 100x. I'm being extravagant there. But if you look at the odds, there's only 1 or 2 companies in a portfolio of, say, 50 that are going to return anything and going to return the fund and allow you to make money. So as an investor, I'm taking moonshots. There's no other way I can do it. I just have to do that, because remember, a VC has investors as well. And they're, called limited partners, LPs, and it tends to be bigger institutional pools of capital, either pension funds, endowments, or, in some cases, very well-funded family offices, that can kind of come into these. So you got to understand the venture economics a little bit as well. And that's the way it works. I'm not saying it's the right way, but it's the way it works, right? To sort of drive outsized returns. By the way, venture has been historically a terrible asset class. I think we've, erased a little bit of that, kind of post 2008, where quantitative easing, has sort of forced more money into more risky asset pools. And so we had a really good run for a long period of time, 15 years. So it kind of paved over a lot of, challenges in the industry. That's why you saw exploding valuations. It's like, wow, we just got all this money. Let's put it to work. And gosh, we're having success here and there. But I think once that falls back to earth, which we're seeing right now, it changes the dynamic a little bit. But typical fund economics, you got to have 1, 2, 3 companies in that portfolio that are going to return your fund.
So, no, thanks for that. We're going to take a moment from our sponsors, and we'll be right back.
Are you an emerging fintech with a limited budget seeking more sales and partners? Introducing Strategic Generation, your partner in leveraging cybersecurity for sales and partner enablement. Fintechs often lose opportunities due to unsophisticated cybersecurity programs. That's where we come in. Strategic Generation assists with due diligence, security posture visibility, penetration testing, and on-demand virtual CISO services. We connect your systems to our partnered platform, and voila! Instant access to real-time diagnostics and compliance frameworks such as SOC 2 and PCI DSS. Gain the confidence of prospects and partners. Strengthen your cybersecurity program and drive success. Stop losing deals due to cybersecurity. Visit strategicgeneration.com and click on Demand CISO to connect with an expert.
just like that, we are back. We get our banner going back again. This conversation is just totally awesome. I think you just dropped a lot of interesting cookies, jewels, whatever the positive word you want to use to really help our audience. You mentioned offline about how this venture has changed.
Mhm.
I mean, 2020, right? Look, dude, you can bet on anything. You can bet on crypto. You can bet on fintech. You can just put money. You can close your eyes, throw money at something, and like GameStop made you $1 million. Now,
Yeah, it's different. It's changed. And I think you get back to that notion of venture economics and understanding how all that works, right? I'd say kind of pre 2020 or maybe even 2022, just throwing money at a lot of stuff. What you're seeing is sort of hyper growth in valuations. And think about it from a fund perspective, right? So I'm putting in money, maybe it's at a high valuation, but that next round I know is going to be at a higher valuation because it's all kind of funny money. And the internal rate of return, the IRR in my return looks amazing. It looks great because of this sort of false expect. It's like the housing market. It goes crazy. It's like the tulip thing. It's like you have a bubble, right? And so we lived in a bubble, and everybody was eating really, really well, right? Because you had money going in, higher valuations. Wow, my fund looks really, really good. Now I'm going to go out and raise more money because I have this unbelievable number in IRR, and everything's great until it's not, right? And I think what we're seeing now is valuations coming back down to earth. We're seeing a lot of down rounds being funded, and they're probably right-sized valuation. But what do you think that does to to fund economics? It kills it. Like it absolutely destroys it to the point where it's going to be really hard to do two things. One, make money because you invested at such a high valuation that will never be achieved again. And the second piece is you can't raise more money. Your LPs looking at this and saying, "No, I'm not investing in another fund." And so the amazing thing that's happening right now is that you're seeing not only startups fail, you're seeing venture funds fail. And we haven't seen that before. There's a big fund which I have incredible respect for, OpenView in Boston, amazing group. They just shut down their fund. I mean,
wow.
they've been around forever. There's another fund out in Europe that just shut down. It's like we can't make this work. We have good companies in our portfolio, but we can't make the math work. So therefore, we can't raise money. Therefore, the party's over. So I think we're seeing that, right? The party's ending. The halcyon days, are way behind us, and it's going to take a good 5 years to work that out. But it's changed. And what does that mean from an investment perspective? You're seeing a lot more money going into existing portfolio companies. You're seeing new money going into companies at a much more reasonable valuation. So I think those things are good. But it also means that the spray and pray approach or just dumping money all over the place, those days are gone. You're seeing much more diligence and more focus, maybe not on top line growth but bottom line growth of companies.
So a question on that, like what
Mhm.
happens to the portfolio companies when the fund shuts down? Like what happens?
Oh, I mean, the fund still exists, right? It's there. So it's still a going concern. The flip side is that VC firm isn't going to put more money into it because they've closed the fund, and maybe their governance goes away as well. So it just sits there. It becomes a passive investment. And I think all these folks, that it doesn't mean that the fund will stay open for another decade. It just doesn't mean that they're putting more money in to work there. So it still stays there, and you keep your fingers crossed.
So what about like the employees though are basically no longer
Yeah.
working?
No.
Okay.
That's right.
Oh yeah, I totally understand that.
Mhm.
So now with the extra scrutiny on due diligence, with the extra, it's not the lower valuations. What's your advice that startups should focus on at this point when they're going? Like, what should they focus on in terms of needing fuel for their company in the form of money? Um, approaching VCs or not approaching VCs. But you know what? I have this really good idea. I believe it's needed in the, like you guys back in the days, right? Look,
Yeah.
yeah, we believe in this thing. It's going to work. We have operational discipline. What are some of the gems that founders can start focusing?
Look, again, I'll flip the script a little bit and try to put it through the lens of a VC, right? They're trying to de-risk investments as best they can. There's a lot of ways to do that, and I'll touch on those in just a second. But they're also looking for a moonshot, something that can return a significant amount of money. So what does that mean? That means that your quote unquote TAM, total addressable market, has to be large enough to say, all right, there's a venture scale business in there somewhere, right? We're not talking about mom and shop. We're not talking, mom and pop, I should say. This is something that has venture scale to it. So I think that's one lens that you just have to be cognizant of. And you've got to make that case. And I would argue if you're going to play in the venture space and you're operating in a small market, you might rethink, where you get capital. Doesn't mean that you can't build a viable business. Doesn't mean that you can't go to adjacencies. But I think that first filter is going to be tough to get over. I think the second piece of it, and this is stage specific, right? But if we're talking early stage, like that team matters. And you just have to take a look in the mirror and take stock in all of that. VCs will de-risk that decision around, is the team, have they had success before? Have they worked together before? Do they come from a pedigreed institution? That's a huge filter. If you look in the mirror and none of those things are true, you better make sure that everything else around that is beefed up, or at least you sort of emphasize those points a little bit. So I think there's a lot of ingredients that go into the cocktail. There's not a one size fits all, but you just got to be honest and you got to take stock on that. And I think for any startup, you have to look outside of your four walls and take advice from people that you trust and know. And I think building out that infrastructure, especially for a CEO, maybe a first time CEO, man, you need somebody to help you out, through that. So don't feel like it's, hey, I got to put all that on my shoulders, but you got to be honest about it. And sometimes that's hard, right? It's like, oh, we got the best idea and the best thing. These VCs are dumb because they don't see it. And the answer is maybe, but the reality of it is they're investors, right? And they have mandates they got to hit and they pattern match. And if it falls out of that pattern match, there ain't nothing. You said to me once, which is great. It's like, if somebody doesn't see value in what you're doing, there's no price cheap enough, right? Low enough, to drive that. And, it's kind of true in venture investing as well. If they don't see the value, it's like, that doesn't matter.
I love when I bring guests on and we have previous relationship outside of the show, and we could pull from different jewels that one said. The thing. So since you gave me one thing that I said to you, another thing that you said to me is never apologize for technology. I love that. I absolutely love that saying. You said it. It was when we went over our meeting. You said, "Dude, never apologize for technology." And I was just like, "Wow." Explain that for the audience because I think that's a good thing, especially for startups.
Yeah.
That especially the startups, in this whole fintech world that we live in, we're basically automating a lot of the traditional banks processes. We have a lot of banking partnership relationships, and you have a lot of, but you're small. I mean, these guys have billions of dollars behind them. You're small. You're taking care of this one function and doing it really good. And sometimes things happen. You said that, I was just like blown away by that.
Yeah. It's critical, and I've been fortunate enough to work with some really really great, incredibly brilliant people, especially on the technology side. They're these folks can do things that I will never do in my lifetime ever. Like and even in my next life I will never do it. It's just that notion of brilliance, and I think the point of all of that are a couple of things. One is startups are really hard. There's probably the hardest thing on the planet to do is to start and build and scale a start. It's really, really tough. And if it wasn't, everyone would do it, and we'd live in utopia. The other side of that is startups are hard. Technology is like incredibly hard, and I think what happens a lot of times, if you're a non-technical person, you think it is fairy dust, that there's somebody in the back room on a computer, typing away. And it's like, easy, just do that, do this, do that. As consumers, we have our devices and we're like, oh, it's so easy to use. Like, the amount of work and developer hours behind that, that go into this. So it's really, really tough. And it's not going to, your product is never done. It's just never finished, right? And it's a really hard but enjoyable progression to see sort of systematic improvements, and it takes time to do it. I think if companies get into a position where they have their first customers, it has to be those expectations have to be managed the right way. But if something doesn't work, and your customer might be like, what the heck, this doesn't work, that's a learning moment. And you have to sort of embrace that, which is to say, okay, why doesn't it work? Tell me more about that. And that might be something that you put on your product roadmap. You start apologizing for stuff, all of a sudden you go from a technology company to a services company where, that customer is mad at you, you have to fix it. And if you go down that path, Nambi, you are going to have 30 different products for 30 different customers. Right? Because then you get into the customization world, which again is services. So, I've always said, I've said it to you, I've said it to every team, that I've been a part of, is never, ever, ever apologize, for your technology. Never do it, because it's always a work in progress. And flip the script and say, hey, this doesn't work. Tell me more about that. Tell me why it doesn't work. Tell me what you would like to see. That's a learning opportunity, but never say you're sorry. Ever.
You know what? This conversation, because when I talk to you, we used to do this. We could just go talk for hours. We're gonna have a follow up, definitely.
All right.
You mentioned something earlier about the team around you. I think I just thought, me, I'm an idea guy. So while you were talking, I'm like, I want to bring them back on, and I want to talk about how a fintech can build their first board. Like, how do you do? What's the process? Who do you get? If you could, obviously, from what you said, from a VC standpoint, one VC has to be, but if you don't, so I think that would be an interesting topic, and we could brainstorm about different topics. But you said it, I thought about it, and I didn't want to. I know if I went down that road, we would spend another 2 hours on this conversation. So I said for our next episode, I definitely agree.
Let's do it. Look, and it's timely too. You look at what happened with OpenAI. Total sort of disintegration of board governance. It's like, what are y'all doing?
I leave, they bring him back, the board. With that, man, I just loved how his people were so behind him, and they really like, dude, if he's out, we're out, and that was just huge, And let's talk about that. That'll be a good conversation for 2024. Matt, man, I'm gonna give you the floor, like I do to all my guests. How people can find you, anything that you want to talk about in terms of companies, businesses, if you're looking to invest in angel, as an angel investor, companies you're looking for. I'm going to give you the stage to do that, and I'm off the stage.
No, look, I mean, people can find me on LinkedIn, pretty straightforward, and you sort of see my background, and feel free to reach out with, questions and thoughts. I think what's interesting is you sort of look out to 2024 and what's going to happen and what's going to change. Again, like what I said, the halcyon days are way behind us. If you're a startup founder, you have to sort of acknowledge that. I would argue, by the way, that today is probably the best time to start a company versus 5 years ago, right? Because you don't have the investment debt, that sort of goes along with it. So I think it's a great time. I think we're going to see a tremendous amount of innovation, come down the pike, because we're going to see a next generation of companies. I'll use the term loosely, but Web 3.0, whatever we want to call it. And that's going to be pretty exciting. We're going to have to work through a little bit of this tumult and headache, but I think it's going to be an exciting time. And money might be harder to come by, but it's probably going to be easier to manage, than it was, even 2 or 3 years ago.
That absolutely brilliant. Thank you so much for your time.
It was a pleasure.
Really appreciate this conversation. We're going to have probably a lot of clips of it going on our platforms. To the audience, thank you for tuning in. We've got a lot of actually questions from Instagram today. Usually get questions from LinkedIn and so forth. So I want to big up my guy, June. Thanks for the questions. Thanks for the engagement. Appreciate it. Yeah, man. And obviously back every Friday, 12 p.m. Eastern Standard. You can catch us live at Tech Behind FinTech. You can look at our previous episodes at techbehindfintech.com. Today was the 153rd episode, so we have a ton of content. Interesting, one of our teammates are going through some of our content to extract some information so we can pump out, and they're like, wow, these are like really good episodes. And I'm like, oh, thank you. I appreciate that. So definitely some content you guys can look at for the past 3 years of us being in this game. On that take, have a wonderful and spectacular weekend. Matt, thanks again, and we'll obviously be in touch and stuff like that.
Well, this is great. I appreciate the opportunity, man. It was a lot of fun.
Yeah, man. So,
and happy holidays.
Oh, happy holidays for sure to everyone, and we'll definitely be around for the next few weeks before we take off for the end of the year. And on that note, we are out.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.